Good afternoon. I'd like to welcome people to our slightly delayed investment market update. We had a little bit of a technical glitch, but I'm sure we'll be back on track now. So thank you for your patience. This call will be recorded and available via a link after the call. We plan to spend about 15 to 20 minutes today just to give you our sense of the investment markets in light of very significant health circumstances that clearly is evolving minute by minute. So the challenge that we see is that periodically there are situations of economic, political, terrorism, or even global health emergencies like we're seeing today, and they have a significant impact in the financial markets in the short run. Now, investment markets, equity markets in particular, have always recovered for the most fundamental of reasons. And that is that people that are running the companies are paid and incented to actually increase the profitability and therefore the valuations of businesses as time goes along, which in turn drives the stock price to a higher point than it was previously. One of the challenges in the short run is that the media, who is pretty good at looking for headlines, and negative headlines seem to sell a little bit better than positive headlines, they tend to amp up people's concerns because they will often talk about certain segments of the market that are the most dramatic. And the reality is, calm is often something that is a little bit better when there are significant circumstances that occur. Now, one of the most important aspects of financial planning is to determine when you need cash. And the reality is that very rarely are the investment markets, particularly when they're volatile, have anything to do with when you actually need cash, let's say for regular income, that sort of thing. And so the reality, very rarely, certainly with our clients, is there a need for cash when market volatility has pushed the markets down. And we think it's really important, therefore, to stick with the original plan of cash flow. And if cash is needed for regular income, obviously maintaining that cash requirement is essential. Now, the reasons for the current volatility, and I'm going to begin with the last point, not the first, is this is not a volatility that's based on any fundamental economic weakness. Frankly, to the contrary, yes, there have been some trade wars in the recent past, but certainly the U.S. economy is viewed to be firing on all cylinders, and as we know how much that impacts the world economic circumstances. So this really is primarily a global healthcare related problem. And I would say secondarily, there has been some overvaluation in the growth aspect of the market. We're going to have a look at that. Now, while we claim no particular capability in covering healthcare issues, we are reading some of the same facts as you folks are, and that the best comparative seems to be SARS, although this has a much higher number of people who have been impacted. 8,000 at SARS versus 125,000 so far, and obviously that number is changing literally minute by minute. Deaths, 774 SARS, and so far a much higher number at 4,613 as of yesterday. The S&P 500 index fell 15% during SARS, and this drop has been 27%. And then you can see on the right-hand side of the screen, we've just modeled what we did know about what happened to the S&P 500 index with SARS. And you can see there that after a fairly steep downturn, it took about 5 months before it had fully recovered to the previous high point. Well, one of the things that we are very pleased with is that despite difficult times like we've been through, that the investment philosophy of core and satellite is paying off. Two primary reasons is that the core investments in public markets, we follow a value versus a growth orientation. And secondly, private debt and equity provides non-correlation to the public markets. And for many of you that are on this call, you will recognize that this is a theme that has been followed for about the last 5 years at Portfolio Stewards. And then the final point I want to make here is that we have had a liquid gold position in portfolios for probably 1.5 to 2 years now, with no specific reason, but just in case we saw any unknown shocks such as we have recently seen. This is a rather busy chart, but a picture paints 1,000 words. And the uppermost part of the chart, it is meant to show price earnings ratios. And what it's really illustrating here is that throughout the world, you can see that the US market was at a fairly elevated, the broad market was at an elevated position from this valuation metric. The Canadian market was the most reasonably priced, and the rest of the world was pretty much in the middle. But when we move down to the bottom, and this is a very important distinction, because I mentioned earlier that we tilt towards value. And you can see this is just the US market, but the same would be true of the Canadian and the rest of the world. But the most overvalued securities are really the growth part of the market. And we can see up here that it is fairly substantially higher than even the last time that there was a significant dip in the markets back in 2008, 2009. In the middle is the broad S&P 500, and at the bottom is the value index that we tend to hug. We do that because it's got more long-term return, but a better risk-adjusted rate of return is the motivation for that. So when we look at what the actual results have been, and this is really right up to the close of business yesterday, we do some comparison here to benchmarks, and as expected, the benchmarks in growth markets will do better than the portfolios that we have. Whoops, I'm going to go back. Simply because there is actually a mix, and we have used, for this purpose, we've used a portfolio of 60% equities and 40% fixed income. However, the benefit of that is seen in downtimes, and you can see that the markets, the Portfolio Stewards portfolio have declined less than the comparable markets using public market indicators. So we believe that that's an example of, or that's really reinforces the point that I had made earlier, that why it is that we were prepared for markets such as this, and significant market shocks. I'm going to turn this part over to Scott Eicher, who's going to address where do we go from here.
So one of the many questions that would be on people's mind is, as Paul indicated, what changes will we be implementing? So broadly speaking, we see this market downturn as an opportunity. When we look across the portfolios and look at different asset classes where we see the greatest opportunities, the greatest opportunities will be in the US equities. Gold, we see limited upside, even though interest rates are coming down, and the Bank of Canada just reduced their rate by another 50 basis points just a few minutes ago. So we will be exiting gold and allocating that to US equities. With the decrease in the Canadian dollar, we will also be increasing the hedge on US equities, so that as the dollar begins to rise when we come out of this, that's not going to reduce returns on the US equities too much. We will obviously continue to be looking for new opportunities in the private debt and equities markets. Those are the areas where we can provide the greatest benefit to portfolios in terms of lower expected volatility with expected higher returns in the long run. So looking at medium term, we're looking at making some adjustments to Canadian equities to further reduce the representation of commodities-based and energy companies within the Canadian equity allocation. As mentioned above, in the short term, we're certainly looking at U.S. equities. And again, as I alluded to with the private debt and equity, non-correlated assets are an extremely important component within the portfolios over the long term.
Thank you, Scott. I think it's fair to say that many people recognize, who have been through one or through up and down markets over the years, recognize that down markets present a fairly significant opportunity sometimes that will be manifested over the long run. And we have had a few calls from people who have a fair bit of cash that's been sitting on the sidelines and view this as an opportunity, as we do, to enter the market with some additional funds, because the valuations are much more reasonable on the equity side. And even when it comes to fixed income, because there is a short-term view, credit concerns that often come up, we're seeing quite a disparity between very, very high-quality government credits and corporate credit. And that usually works its way out over a little bit of time. And we view that there's a significant opportunity. Overall, we view our role here to provide logical, holistic financial planning that is really customized to the unique needs of each of our clients. And most of you have seen that when you work with your individual advisor, really trying to identify what your particular needs are and make sure that we have a long-term game plan in place to deliver on that. And in addition to that, we want to provide quality risk-adjusted portfolio management so that the planning goals referred to above will be achieved. We take great pride in the confidence that our clients have placed in us, and we really appreciate at this difficult time just sticking with the plan. If you have any individual concerns, reach out to your advisor, and I'm sure that they will be able to add a little bit more color as it pertains to your individual circumstances. But I want to thank you for joining us for this call. And Shelby, are there any questions that people have written in as yet?
Not as of yet, but if you do have any questions, put them in either the chat or the question and answer box on your screen.
Very good. And I want to thank everybody for joining us today, and appreciate your time, and have a great weekend. And let's, most of all, be mindful of the health needs of our family and friends and others around the world. We do have a question that has just come up. What are the asset classes? And Scott, did you want to address that broadly?
Sure. At a very high level, the two very broad asset classes would be fixed income and equities. So within the equities, we divide it down into regions. So we have Canadian equities, US, international, which includes emerging markets. So when we look at the three equity sub-asset classes, the three regions, given that there has been a broad decline overall in equities around the world, definitely equities certainly have a lot of opportunity. However, when you look at each individual region, we believe the US has the greatest opportunity among all three.
A question has also been asked about what are non-correlated asset classes? And let me address that very briefly. What we mean by non-correlated is that if one particular market goes up or down, other aspects, and they're often in the private debt and equity area, really they're influenced to a very minor degree or not at all. And so we're looking for things that balance out the volatility that we see in the public markets, and we don't see much change there. An example of that would be a mortgage fund, where if there are is a mortgage being held and the property is still in good shape, obviously the realization of that mortgage is has very little to do with what's happening in the public equity markets. Scott, would you like to address that question, which is define short and medium term?
Sure. I would define short term as probably within the next couple of months, but we would be acting closer in the next, probably starting next week in terms of taking the initial steps. Medium term would be probably 6 to 12 months time frame.
There is another question. Has your active management beaten the indices? And for those people who have been with Portfolio Stewards for some time, we believe it is very difficult to outperform the indexes. So what that is sort of feeds into our fundamental philosophy of looking at things that are not just index-based, but adds some tilts. But we are not actively looking at lots of stock trading because we just do not believe that that yields the results once you factor in costs. Did you want to add to that, Scott?
Yeah. One of the most important aspects of a properly diversified and constructed portfolio is your asset allocation, rather than actively trying to buy and sell and time the markets and whatnot. The allocations to the alternative fixed income funds that we use that have very low to no correlation to the markets, that's a very significant asset allocation that we have across all of our portfolios. And so that has significantly reduced the overall volatility for client portfolios as we've been riding through this very volatile time. So it really has more to do with the long-term portfolio construction rather than active management and trying to time and trade the markets.
So one of the questions that has come in, it sounds like you're timing sectors rather than picking stocks. And we would say that we are not market timers. What we do look at is we do look at valuation metrics. And if we see the need to make some changes, we will be making strategic asset allocation changes because we do not claim that we can be precise in any timing, nor do we think many other people can be either, for that matter. So thank you for those questions. I think we've had a good summary and range of questions. Thank you for your time and for your confidence, and have a great weekend. Bye for now.